Monetary trends are the heartbeat of the financial world. They dictate the flow of money, influencing everything from interest rates to inflation. These trends, often subtle and complex, exert a powerful force on various markets, including the Forex and cryptocurrency landscapes. Understanding these trends is paramount for investors seeking to navigate the turbulent waters of global finance. Consider monetary trends as the underlying currents in a vast ocean. While individual waves may seem random, they are ultimately driven by these larger forces. Similarly, daily fluctuations in Forex and cryptocurrency markets are often reflections of broader monetary shifts. These trends are shaped by central banks, with the U.S. Federal Reserve at the helm, wielding significant influence over the global financial system. The Federal Reserve, through its monetary policies, sets the tone for interest rates and inflation, directly impacting the value of the U.S. dollar. This in turn creates a ripple effect across the global Forex market, as currencies are constantly being weighed against one another. Cryptocurrencies, while often touted for their decentralized nature, are not immune to these monetary forces. The rise and fall of Bitcoin, for instance, are often correlated with global liquidity conditions, which are directly influenced by the Federal Reserve's actions. The Federal Reserve, or the Fed, shapes monetary trends. Led by Chair Jerome Powell, it manages interest rates and inflation. The Fed's goal is a stable economy, controlling money and credit supply. The federal funds rate influences borrowing costs. Lower rates boost spending, higher rates curb inflation. Inflation affects prices and purchasing power. The Fed aims for a 2% inflation rate. Its decisions impact the U.S. and global markets. The Forex market, the largest and most liquid financial market in the world, is where currencies are traded against each other. At its core, Forex trading involves exchanging one currency for another, hoping to profit from the fluctuations in their relative values. Monetary policies, particularly interest rate decisions made by central banks like the Federal Reserve, are key drivers of these currency fluctuations. When a central bank raises interest rates, its currency typically strengthens as investors are drawn to the higher returns offered on investments in that currency. For example, if the Federal Reserve raises interest rates while other central banks keep theirs stable, the US dollar will likely appreciate in value against other currencies. This is because investors seeking higher returns will sell their holdings in other currencies to buy US dollar-denominated assets, increasing demand for the dollar, and thus its value. Conversely, if the Fed lowers interest rates while other central banks maintain or raise theirs, the US dollar is likely to depreciate as investors seek higher returns elsewhere. This interplay of interest rate differentials across different countries forms the basis for many Forex trading strategies. Cryptocurrencies like Bitcoin and Ethereum have emerged as a new asset class, operating independently of traditional financial systems. However, despite their decentralized nature, they are not immune to the influence of monetary policies. The actions of central banks, particularly the Federal Reserve, can significantly impact the cryptocurrency market. One way this influence manifests is through the impact on liquidity. When the Fed pursues loose monetary policies, such as lowering interest rates or injecting money into the economy, it increases the supply of money in circulation. This abundance of liquidity can find its way into riskier assets, including cryptocurrencies, driving up their prices. Conversely, when the Fed tightens monetary policy by raising interest rates or reducing its balance sheet, it can lead to a decrease in liquidity. This often results in investors moving away from riskier assets like cryptocurrencies towards safer havens, potentially leading to a decline in cryptocurrency prices. Furthermore, the regulatory landscape for cryptocurrencies, which is still evolving, can be influenced by monetary policies. For instance, concerns about inflation or financial stability may prompt regulators to implement stricter rules for cryptocurrencies, potentially impacting their adoption and value. Understanding monetary trends is like having a compass in financial markets. Follow the Fed. Watch their announcements and speeches. Track economic indicators like inflation and employment data. Analyze interest rate differentials between major economies. Adjust your strategies and risk tolerance accordingly. Stay informed and continuously educate yourself. As we navigate the complexities of the 21st century financial landscape, understanding monetary trends is no longer optional, but essential. The powerful currents of monetary policy, steered by institutions like the Federal Reserve, continue to shape the Forex, cryptocurrency, and global financial markets. The decisions made by central bankers, often in response to economic data and global events, reverberate through the interconnected web of finance, impacting investors and individuals alike. As technology advances and new financial instruments emerge, the interplay between monetary policy and market dynamics will only become more intricate. Therefore, whether you're a seasoned trader, a curious investor, or simply someone seeking to understand the forces shaping our financial world, delving deeper into the realm of monetary policy is a journey worth undertaking. By grasping the fundamentals of central banking, interest rates, inflation, and their impact on various markets, you can begin to chart your own course through the exciting and often turbulent waters of global finance.